Hello, this is Jordan. This video is being recorded on Tuesday, July 19th, 2022. Thank you so much for joining me today. And in this video, I'm going to take a deeper dive on gold's technicals. I'm going to look at one sentiment indicator, sprinkle in some macro commentary. I don't want this video to get too long because if I was doing a major deep dive on technicals, I could ramble on for an hour here. So this is only a piece, but I wanted to give a non-gold bug look at things. And I did record this video yesterday afternoon, but there was an issue with the recording, so I apologize for that. I hope this works. First thing, looking at the technicals, when we're looking at technicals, what really matters is price and price action. Just a comment. I see a lot of charts that just they're focused on indicators and just too many other things that are not really related to the price and price action. So pure technical analysis starts with looking at the price and price action, and also intermarket analysis, which I'll get into in the next slide, is so important, and even more so with a market like gold, where gold doesn't do well when the other markets are doing well and capital is flowing into those other markets and asset classes. But I digress. So the issue with gold technically is it looks like gold has made a double top. If you look there in the yellow, those 3 months, you have February, March, and April. And even though February was a strong month, gold closed off the high that month. Then you have the peak in March where gold traded up to, I want to say 2050, 2060, and then it ended up closing below 1950. So that's a huge sign of distribution. That candle's pretty ugly. And then you have the one the next month, which, in April, where gold ended up, at one point it traded above 2000, but it ended up closing, I want to say, around 1930. So you had 3 months there of distribution, the last 2 months particularly nasty. And so when you look at a lot of long-term charts, this does look like a double top, but we can't always go by looks. But nevertheless, this does have the makings of a double top in this market. And, further evidence of that is the aggressive sell-off that we've seen. And so what this market, or what the technicals on gold potentially reflect, is the market is thinking there's not going to be a Fed pivot that soon, and we're not going to see easy money. We're not going to see a big decline in real interest rates. That's what this price action, if this is a double top and there's implications over the next year or two, that's what this interpretation is reflecting. And so the 3 lines there, I kind of sketched out some, rough possibilities. If you're a bull, you're going to say, well, it's going to hold 1675 and rocket back higher. There is a scenario where it could break lower, have a false breakdown, then rebound. And then there's just the, call it the 2013 scenario where gold's crashing. It's going to keep falling into the 1400s. So I'm not, predicting any of those things, at least not yet, but I'm just saying, okay, those are potential possibilities, because we need to look at, what, when we're evaluating markets, what are the possibilities, and then what do the probabilities say is likely versus what is not likely. But that's where we are. And last thing about this chart is we need to see how gold acts around 1675 or even below it, because if gold puts in a strong monthly hammer, a monthly reversal candle this month, maybe gold closes the month at 1750 or 1780, it rallies, or, maybe gold breaks below, and then next month it trades into the low to mid 1600s, but puts in a super bullish reversal candle. That changes the interpretation of the technicals significantly. So that's something that we have to watch for. But that's really what I see with gold's technicals. And, I'll talk about the cup and handle pattern a little bit later. But another thing is, and I don't see that, this is rare when I look at Twitter and other areas. I don't see people evaluating intermarket analysis and how gold is performing against the other asset classes. This is a big difference between now versus 2013. I talked about that in another video, but here we're looking at how is gold performing against other asset classes. Well, when gold really did have that crash in late 2012, the first half of 2013, gold was declining hard against everything. You can see down against the S&P, gold against foreign currencies. At one point had declined 30% over a 9-month period. Gold against copper trending down, gold against commodities trending down. Even though if we look at the top right there, that's really the breakdown that gold has had. I know 1675 is important, but when we're drawing trend lines and horizontal lines and such, you really want to connect them to as many price points as you can. That is going to, the more points you can connect them to, the more significant they are. And so we can see that gold has already broken down technically, falling below the uptrend line from early 2021. And there is a potential measured downside target. I want to say 1630, 40, 1650, something like that. I'll have to take a deeper look. But if you just look at the decline from 2020 into early 21, and then you measure that going down, I mean, it's over $300. So if you measure that from the 2022 peak, that's how you can come up with a potential downside target. So that's really where we see the gold breakdown. It's already broken down. It doesn't need to wait to go below 1675. So this is more significant in my opinion. But, back to the evaluating gold in real terms, gold has been trending up against the S&P 500. Who knows? I mean, the S&P 500, good day today. Maybe it's going to continue and rally up to the 200-day moving average. That was my prediction a month or so ago. We see that often in bear markets. Even the worst bear markets, the S&P rallies up and tests the 200-day before it rolls over, and you see significant losses. I mean, that's really your secondary get-out point of stocks, is in a bear market when it tests the 200-day. You see that somewhere in a lot of bad bear markets from the 7th month to the 10th month or so, just going off my data. Gold against foreign currencies, still holding up really well. I mean, that could come down, that could correct some more. Even if we did see, 5% decline in gold from here, gold against foreign currencies, I don't see that crashing anywhere close to the way it did in 2012, 2013. So it's still holding up really well. The yen and the euro, that's what I was trying to remember. I mean, they're just basket cases. So gold in foreign currencies is much stronger than it was in 2013. Gold against copper, that just broke out. Gold against the CRB, that already crashed because gold was correcting. Energy, commodities were on fire. So it's possible that gold could at some point soon turn up against the CRB. And so the macro situation is completely different now versus 2013. I mean, 2013, S&P on the cusp of breaking out of a 13-year base. Now we're in a bear market, probably in a recession. So it's a completely different situation. But the bottom line here is gold is holding up, even though gold is technically, nominally speaking, in real terms, gold is in pretty good shape considering in nominal terms how it looks. So that's a big difference. That's why you have to look at, you have to compare gold to all the other markets. Intermarket analysis is so important. Now, looking at sentiment, I don't want to talk about the COT because this could be a 30-minute video. But looking at the COT, there is some more room for specs to sell. I mean, I know that managed money, which is one category, I know they're net short gold, and I think the last time that happened was 2018. If we look here at the Optix indicator from Sentiment Trader, this has come down. It's near a real extreme. I mean, it's already at an extreme, but there is a bit more room here for the Optix to come down. 28% bulls as of a couple days ago. So if gold is to trade into the mid 1600s, you'd probably see the Optix indicator come down close to 20, and then we'd be looking at real extremes. And then that's the point where the market is really ripe for a rally and a snapback. So, and I would say the same thing with the COT. Sentiment it's getting close to an extreme. It's not low enough that it can stop gold from dropping, another $50 or $75. But in that, if that were to happen, these sentiment indicators would be flashing extremes, and then a rally would be highly probable at that point. Now, last thing, let's look at the weekly line chart. Looking at a couple scenarios, two potential outcomes here, and one thing we can see the breakdown if you look at the arrows in 21 and 22. That's really where the breakdown has occurred. Gold was trading in that triangle. It broke above it. Then it's completely lost it. So that's where the breakdown is. That projects it down to the mid 1600s. So we could see some more selling. And, looking at fundamental catalysts in the macro, if the RC is rate cuts, 2007 started cutting rates, 2008 in September. That was when I believe the Fed pushed rates from about 2% down to 0, essentially. So a month later was when gold started a huge rebound, a huge move higher. And then, of course, let's look at 2018. 2018 market bottomed. Then a couple months later, December, last rate hike. Then in May and June, I think it was in May, that's when the Fed indicated they were going to start cutting rates. June, they start cutting rates. Gold has a huge breakout. So that shows you the importance of fundamental catalysts and Federal Reserve policy. And so, we have these setups in these charts, but it's so important to remember that technicals are a context. In the majority of cases, they're not a catalyst. So technicals are a context, and they tell you what's possible. And so the cup and handle pattern, that doesn't tell you when gold is going to break out, but it does tell you if gold breaks out and trades above 2,100, there's potential for it to go vertical to $3,000, $4,000 an ounce. That's what it tells you. It doesn't tell you that gold's going to break out in the next month, the next year, the next 6 months, the next 2 years. So it's important to remember that. But I'm not downplaying technicals if they look bad, because it's clear that the market, with the potential double top in gold, and you see the technical breakdown here, the market is thinking we're not going to see an easy Fed anytime soon. And, therefore, real interest rates, which drive gold, they're not going to plunge anytime soon. But with all that said, we know that the Fed stopping the hikes and then turning to rate cuts or however they would ease policy, we know that is the bullish fundamental catalyst for gold. And, how much of that we see or how soon, that is all going to depend on the severity of this economic downturn in the recession that we're probably already in. Is it going to be mild? How much longer is it going to last? Is it going to require significant rate cuts, significant stimulus? Is it only going to require, a few rate cuts, or, they're not going to cut rates? We're only going to see a little bit of stimulus. The economy is going to be okay. So in that scenario, you're going to get more of potentially something in the lower half there where, policy, it is moving to a point where we're going to see a move in gold, in my opinion, but it's just a question of how significant is it going to be. Now, if we have a significant recession and inflation is really crashing, then the Fed, we know they're going to cut rates at some point. The market is projecting Q1 or Q2, we'll call it spring of next year. If it's a really severe, significant downturn, maybe they have to cut rates to 0 again, or 1%, from, call it 3%. And, maybe you need fiscal stimulus on top of that. Then you would get the move in the top half there, where gold is going to break out of the cup and handle pattern, really explode. If you look at the two boxes, those are about 40% moves in gold. So those signaled what happened, coming out of the COVID crash and coming out of the 2008 bottom. So that's something to keep in mind versus, and I think if you look at from the 2018 low up to the peak in January, February, of 2020. I think that was about a 40% move. So just some numbers to keep in mind. But again, it's going to depend on the severity of the recession and what kind of policy response is needed. And if it's a significant downturn and a significant recession, you're more likely to get an outcome in the top half of this chart. And look, even in a more deflationary scenario, let's say that brings gold down to 1600 because the recession is really severe, that is better for gold. That is a near a best case scenario because that's going to require a huge response, huge Fed rate cuts, fiscal stimulus, etc. Then you get the outcome we're talking about there on the top half. However, if it's a more mild recession, the Fed doesn't have to cut rates to zero. Fiscal stimulus can be on hold for a little while. The economy is going to rebound. Inflation comes all the way down to 2% again. Then maybe you have something in the lower half where gold is just going to continue to consolidate and it's not going to break out until the recession after the one that we're having. I'm not predicting that. I'm just laying out a different scenario. But it's important to think about all these scenarios. I still lean towards the top one, looking at what the dollar's been doing, looking at the declines that we've seen in oil, copper, and long-term bond yields, looking at the declines in break-evens. These are all signaling potential repeats of the COVID crash in 2008. So I think it's more likely than not that the market at some point is going to force the Fed into being easy again. And that's where you get the scenario at the top and you get a super bullish breakout of the cup and handle pattern. So that's all for this video. I know it was kind of long, but let me know what you think. Leave a comment below and I'll talk to you guys again in the next video.